Number two, not understanding your tax residency. So because you move to a new country, it doesn't mean you automatically trigger a new tax residency status. This is something that you have to apply for, but also you need to understand how it works from a country by country basis. So in the UK, for example, the calendar tax year is April to April, whereas a lot of the rest of the world is a calendar year. So a good example for this is, let's say you're moving to Europe, you're from the UK, you've got an ISA in the UK worth £300,000 and 150,000 of that is unrealised gains. If you realise the ISA as a UK tax resident, that's tax-free, but if you realise it in a country where it is taxed, you could end up with a huge tax bill. Now, if you're moving to a country, for example, in April or May, it means that if you go into a country where it's a calendar tax year, so from January to December, you're actually going to become a tax resident in that new country, which means that you could be paying capital gains tax on the gains within the ISA. Whereas if you sold the ISA in December, which was the previous calendar tax year, that wouldn't apply. Now there are other scenarios where, for example, this may be different. So if you move towards the end of the year where you hadn't been in that country for more than 6 months, then you may end up being a tax resident in the UK. But it depends on the days, and it's difficult working with two different tax years. There is the ability to have a split tax year as well, but it's on a case-by-case basis.